Yo guys, welcome to the new video. In this video, I will exactly show you how to identify the liquidity levels in the market in which the smart money people and the retailers will get trapped, and I will show you the exact strategy which I use for my 7-figure funded accounts. I will show you the exact strategy. So this is the structure of the market which the smart money will look at. They will think that structure is will move like this, and they will draw some order blocks like this from here. They will draw some order blocks and they will try to play from that order blocks, but the reality of the trading don't look like this. It's a fake structure. The structure of the market is usually like this: higher highs, higher lows, and they will give fake break of the structures and they will move in the real trend, and sometimes there will be no pullback. Sometimes this will happen. This is just the liquidity injections in the market. The structure is created by the market makers to introduce the liquidity into the market, because without highs and lows there will be no liquidity in the market. Every high and low contains the liquidity in the market. For a transaction to be happen, for the market makers they should provide the liquidity. So where's the liquidity? The liquidity will be at every high and every low. So after the money is taken, then the transaction will be happened at certain timings like New York Open and London Open kill zones. Then the money will get transferred and then they will move in the opposite direction. This is the main aim of the liquidity on the every high and every low of the market. This is how the smart money people will get trapped. So in this situation, what will liquidity inducement traders will do is will assume a buy. Will assume a buy. I am just showing the hindsight data. We will assume a buy. What the smart money people will do is they think this is a break of the structure and they will play this order block. They will play the cells. But the reality is it's a fake order block. It's a fake thing. This is how the retailers have lost here and the retailers have lost there. They hit SL here and they got SL hit there. They got stopped out 2 times. Now the real people will enter here. The real smart money people will enter here. Real smart money. This is how the liquidity inducement theorem people do. Fixed tenor or I do. This work for my funding challenges and funding accounts. This is the way I trade the markets from the liquidity point standpoint to the liquidity point standpoint. Now I will explain you how to combine the both structure and the liquidity of the markets to give the better entries for us. As you all thought the structure is right, the structure is there in the market, but you were thought in the wrong way about the structure of the market. You were thought that it is very clean to be like this, like this, like this, like this. There will be order block something or break block, it will break. But it's not, it won't look like this. It will be something like rangy stuff. Sometimes the engineering of the liquidity will be takes place. Sometimes it will be ranges, it will range and it will give break of the structure. This is how the real structure looks like in the market, right? This is what the real structure in the market look like. I will explain what happened in this scenario to you guys. In this scenario, what the market makers want to do is they want to induce people before to move in the real direction. So we see the market is in uptrend. The market is in uptrend. Here, to induce the liquidity, what the market makers should do, they should give a false break of the structure. Now, what the market smart money people will think, they will think that above the 50% it's a good place to sell the market. So they will sell the order blocks above 50%. So this reaction is why this reaction happened here. This was the reaction because of the smart money people. Because smart money people have sold here, sold here, sold here. This is why the engineering of the liquidity and ranges come into the play. Sometimes you will notice why the ranging market is there, because it's just in the higher time frame demand or supply zone which is fake. The ranges only usually happen most probably when they are in the fake order blocks or fake charts in the high time frame. So in this range scenario, it is more probable to take buys and take sells because of the high time frame. The ranges are the best for me. I take many buys and I take many sells with fixed 3 pip stop losses. Yeah, after this explanation, I will show you the real charts so that you can know what I am doing. This is how the real market looks like. Liquidity grabs, liquidity grabs, liquidity grabs, liquidity grabs. And I will show you how to combine the both structure and the liquidity in order to get the better entries for your trades. Let's say the structure is moving like this. Okay, the structure is bullish. Let's say structure is bullish. I don't take a order block like this here. If there is order block in the 50%, I don't take like this. I only enter the market whether the wherever the retail people and the smart money people get trapped. So I patiently wait for a trap to be happened. So here the trap happened. Trap here happened, right? I won't show you the entry pattern here because it's for the private group membership. But I can offer you the teachings of a book I have written about the liquidity inducement theorems. If you can have experience in the smart money concept for 2 years, in the description I have given my details. You can contact me. I can send you the PDF of the book I written. This is where I enter the market. This is where I enter the market, and this is my target liquidity. This is my entry liquidity. This is my target liquidity. I always enter the liquidity, and I always leave at the liquidity. So this is the place where the liquidity will become. This is where the engineering liquidity will come. In this place, the market makers will engineer liquidity to gain more number of smart money people trapped. The market maker intentionally give this pullback and they will range the price like this. They will range the price. So in this scenario, I will be in the cells here. I will be in the cells here. I will be in the cells here and I will be in the buys here. If this taken out, why I am in the cells here without this thing is taken out? Because the market is about the game of probabilities. We can't say whether this liquidity is going to take out or not, and we can't say whether it's a break of the structure or a liquidity graph. We should just play our odds right. So here, if there is any previous day liquidity or any previous day internal liquidity is taken out, I will be comfortably in the cells. And if it's taken out, these buys are even more probable because the liquidities are aligning. Here the daily liquidity is aligning and the 4-hour liquidity is aligning, let's say. So I am more comfortable playing the buys than sells. The sells are also probable because we are in the premium. We can think like it's a break of the structure, etc. But the more probable is sells rather than buys. And the liquidity is the main confluence here. The liquidity, the range liquidity is taken, so that's why. The market can move like this for months because of the liquidity to engineer more liquidity, and then market will continue in the real direction. This is how the liquidity cycle works. If you go to the gold, you can understand the market moves on this cycle only, AMD cycle. This is called ICT's AMD cycle. Let's say this is the range and we get a fake breakout from the range, and the market makers will move in the right direction. This fake breakout is to engineer more liquidity into the markets. That fake breakout is to just to engineer more liquidity into the markets. If there is a range like this, many smart money people or retail people will buy because retail people will have buy stops there, buy stops, and the smart money people will think this is the way to play the market. So the market maker successfully taken SNR traders and the supply and demand traders here. This is where the real supply come. There should be a supply in order to get a healthier move in the market. There is no move without a supply or demand or an imbalance. Those two things should be there in order to form the high or low of the day. This is how the market moves in terms of liquidity to the liquidity point, and I will show you some data or the trades this week I took on the GBP USD using this simple trade pattern. Let's analyze from the daily perspective. 1600, 240, it's enough I think. Run on the fractals indicator. I always, before coming to the day, I always identify the liquidities. This is one liquidity point, and this is one liquidity point. This is one simple liquidity, simple concepts they are. Right? Now, if I am in this day, can you see after the buy side liquidity is taken, can you see the huge push towards the downwards? I will be sells in this here because this is date of the day. I will be sells in this here Asian session. I will sell the market up to some sort of buy side liquidity. In this scenario, you can understand by using common sense. You can understand where the retailers will have their stop losses. There's a clear structure point with speed and aggression taking out, and there's a clear order block with the imbalance. So that's why this reaction came. The small reaction is engineered by the market makers in order to trap the liquidity of the smart money. See, I just waited patiently for this liquidity to be taken out here by the wick. Can you see the speed and aggression wick? And I'm in buys here because of this. And also, in this scenario, we are using both the smart money and the liquidity concepts. I will show you. Because when you draw FIP from this level to this level, this liquidity point is in the below 50%. Now the structure is saying we are in the below 50%, it's a good time to buy, and the liquidity is also saying the previous day sectional liquidity is taken and it's a good time to buy. So here in this scenario, they both are telling the same thing, buy. So these are the very high probable trades. This is how we acquire high RR in the trading, 50 RR, 60 RR. This is how the market moves. And in the same scenario, this is the continuation trade. We call it as a continuation trade. So in the continuation trades, rather than like this, there is a scenario of continuing to the upside, 50-50% chance like continuation or the reversal. So in this scenario, when the market is here, there is a chance of getting buys and getting sells. So in this scenario, this is the previous day sectional liquidity, and after taking the previous day sectional liquidity, I am in this sells 10:30 exact because there is a high probability chance it can go down or it can go up because we are in the uptrend, right? And we are in the impulsive move. We are not in this liquidity grab move. This is just a liquidity grab. I told you, right? This is just a liquidity grab. That's why the buys are very high probable. We should only trade when the confluences are in our side. We should not trade the market when the odds are opposite to us. Can you see the same pattern happens over and again in the markets? It's a repeatable pattern. If you can understand this pattern very well, you can be insanely profitable. Can you see how many times it is happening in the markets? Insanely profitable strategy. If you can master this single strategy, you can change your entire life. You will get funded millions of dollars. Same thing. This is what the retailer's liquidity concept. I will explain it in the new videos because it needs a separate series. Retailer's liquidity taken. If you see this black candle, strong candle, what the retailers thought is when there is a trend line and there is a body closing after the trend line, what their thought is they should buy. They will buy here, the stop loss is there, and we know this is a liquidity stop hand, and the liquidity stop hand is below the 50% of the structure. Now it's a good place to buy. We buy the market until this trend line liquidity is taken out. The same thing, buy side liquidity is taken, same thing, structural oscillations. It can continue, right? It can continue or it can go down. We don't know here, 50-50 chances here. But here 90-80 chance, and here also 90-80 chance. And we are in cells here, the same thing again and again. The liquidity is also supporting and the structure is also supporting. We buy here, same. We got another buy opportunity here. Simple trading, buy, and we got another buy opportunity here. Simple trading. This is how I trade the market flow from the liquidity point to liquidity point. If you want to learn this stuff of the liquidity point to the liquidity point, for the May mentorship, I am offering this bootcamp for $50. It's a very insane value. You can change your life if you can afford $50 for this mentorship, because I want to help traders who are struggling with failing accounts, because I also came with that stage. I also lost many tens of funded accounts and funding challenges too. I want to really help the traders. So if you want to use this offer, just I gave my WhatsApp number in the description. Just message me. We can get contact there. Have a good day, guys. Peace.